Finance Watch is a non-profit association dedicated to reforming financial regulation in the interest of citizens. The organisation's work covers many topics, including public finance, digital finance, retail and inclusion, sustainable finance, and financial stability and supervision, the focus of this video. In 2008, the world experienced the worst financial crisis since the Great Depression. Financial institutions knew they were too big to fail and took reckless risks in the confidence that taxpayers would cover their losses if things went wrong, a phenomenon known as moral hazard. With little incentive to act responsibly, ever greater risks were taken in the pursuit of private profit. When the crash came, it devastated economies, triggered mass unemployment, and left taxpayers to pay for huge bank bailouts. Trillions of euros in public funds supported emergency rescues, which strained national budgets, suppressed public services, and deepened inequality. The aftershocks rippled through the economy for years, prolonging instability and fueling the Eurozone crisis. Society bore an enormous cost. In response, governments and international institutions introduced global standards to reduce risky practices. Finance Watch was founded in this post-crisis period to act as a counterweight to the financial lobby and ensure financial rules serve the public interest. But today, hard-won safeguards are being weakened. Memories of the crisis have faded, and the financial lobby has returned in full force. At the EU, financial industry representatives increasingly argue that existing regulations are a burden, and that deregulation will improve the competitiveness of the European economy. Policymakers are buying into this argument, undoing the very rules designed to protect the system. This is evident with the global banking rules known as Basel III. Designed after the crisis to make banks safer, these rules introduce requirements for banks to better manage their risks and have more of their own resources, known as capital. With more capital, banks are less likely to collapse, shielding taxpayers from expensive bailouts. Yet in the EU, as in the US, implementation has been diluted and delayed. Banks have received exemptions and extensions. For instance, in autumn 2024, the European Parliament accepted a proposal to delay implementation of the Fundamental Review of the Trading Book, or the FRTB. This rule was designed to ensure banks can handle losses from market risks, like when they trade securities and derivatives. It was introduced in 2016 as part of global standards, but has now been pushed back to 2026 in the EU. These kind of concessions don't happen by accident. The financial lobby plays a major role. They argue that rules which make banks more resilient limit lending and therefore economic growth. But these claims do not hold up to scrutiny. Safer banks lend more, not less. Financial stability isn't a barrier to growth, it's a prerequisite. When policymakers, like members of European Parliament, bow to pressure and loosen rules, the risks don't disappear. They are transferred to society. An increasing number of financial institutions are too big to fail, which means taxpayers, consumers, and workers ultimately pay the price. This dynamic effectively privatizes profits while socializing risks. At Finance Watch, we work to counter dangerous narratives and ensure that financial regulation protects society as a whole. Drawing on expertise gained from working in the financial industry, our research gives policymakers the evidence they need to make informed decisions. Some areas Finance Watch is working on include 1. Strong global rules, advocating for international cooperation on the full and timely application of the Basel III banking rules in Europe and beyond, without loopholes, without delays. 2. Addressing emerging risks, ensuring regulations respond to a complex and evolving financial sector. For example, non-bank financial institutions, NBFIs, such as investment funds or pension funds, manage 41% of EU financial assets and are tightly interconnected with big banks. However, this systemic importance is not reflected in existing regulation. Similarly, digitalization invites new risks in areas such as artificial intelligence or crypto assets. Finance Watch calls for safeguards to close the gaps. 3. Protection against climate risks. Banks still heavily invest in fossil fuel industries, which not only feeds climate chaos and nurtures systemic financial risk, but also exposes their assets to significant financial losses. As the world transitions to clean energy, these carbon-intensive investments will lose value. Rules are needed to ensure banks can manage these risks. 4. Strengthening the EU crisis management framework and advocating for improved bank recovery and resolution rules in order to protect financial stability and manage failing banks without resorting to public money. And finally, 5. Addressing securitization. highlighting the risks of packaging loans into financial products for sale on capital markets. This technical practice, which played a key role in the 2008 crisis, is being revived as a solution to the EU's funding challenges. In reality, securitization does little for the real economy, instead boosting short-term bank profits while increasing systemic risk. Finance Watch also advocates for more effective financial supervision to ensure existing regulations are properly applied. Currently, Europe's supervisory authorities face significant challenges, including inadequate resources, regulatory capture, governance conflicts, and limited enforcement powers, all undermining the implementation of financial rules. The collapse of Credit Suisse in March 2023 was a recent reminder of the dangers of ineffective supervision. Years of risk-taking and mismanagement went unchecked, culminating in the failure of one of the world's biggest banks. This triggered a crisis that required an emergency takeover. Once again, a too-big-to-fail bank was in part rescued by resorting to public money. The lesson is clear. Stronger regulation, applied under effective supervision, is urgently needed to safeguard financial stability. Only 15 years on from the Great Recession, delayed reforms, diluted rules, and a return to risky practices are setting the stage for the next crisis. Finance Watch is society's voice to ensure this doesn't happen. The next financial crisis isn't inevitable, it's a choice. By resisting an international race to the bottom on banking rules, advocating for global cooperation, and addressing emerging risks, it's possible to safeguard financial stability and protect future generations. The best way to shift policymakers' minds is often via coordinated civil society advocacy and collective action. This is where Finance Watch members come in. Finance Watch members include consumer groups, housing associations, trade unions, NGOs, financial experts, academics, and other civil society groups, all strictly independent from the financial industry. Members are present in 20 EU countries, representing interests of citizens across Europe. Finance Watch facilitates members-only stability and supervision working group meetings. These meetings are opportunities to hear from other Finance Watch members across Europe about their initiatives, arguments, successes and struggles when it comes to advocating for financial stability. It's also how members can hear about the latest developments in EU financial regulation. Members also contribute to Finance Watch's publications and campaigns. Their expertise ensures Finance Watch remains effective in promoting a fairer, more resilient financial system. If you want to dive even deeper into the topic of stability and supervision, or apply to become a Finance Watch member, reach out to our policy team now. Let's join forces to make finance serve society.